Hey everyone, how you doing today? Again, we are welcoming back a guest from last week, Stephen Dow. How you doing, sir?
I'm doing fantastic. How are you, sir?
I'm doing really well, man. So again, shout out to you, right? I frankly challenged you last week, didn't know how it was going to go, right? You're kind of filling, right? You and Velocity Mortgage are filling an important need on this channel, right? Between bank loans and hard money, right?
Oh yeah,
You're the non-QM or non-qualified mortgage market is important, growing, and you're publicly traded. So you came through. The early feedback is responsive, and that's all I could ask for, right?
and that's all I can ask for is an opportunity. So
Yeah,
I'm glad it's working out.
yeah. So yes answers are great, but also a fast no answer is great. I mean that's all I could. That's all I told my audience. I can't
Right.
promise yes. A fast no is, at least they can move on to something else. So I appreciate that. But again, because you are publicly traded, you have to read a
Yes, sir.
disclaimer for marketing. They
Yes.
slapped our hands last week. So go ahead.
So again, let's just start off by saying, although I work for Velocity Mortgage Capital, all the
Opinions? Yeah.
opinions on this show are of my own, and that's pretty much it.
Yeah. Yeah. This is Mike and Steven talking. This is just
Right.
fun because we are trying to help people realize, again, when I started doing this, and really in 2010, there was no NQM, or at least I didn't know about this market. It was really
Right.
birthed out
Very
of
small market.
it was birthed
Right.
out of the Great Recession. And now it's mature and it's programs. And when there gets maturity, rates get better. Competition,
Right.
rates get better. And one of the things that we learned last week is you have a couple of kind of, I don't know what I want to call them, season programs or programs that you offer. We're going to talk
Sure.
about two of them this week and two of them next week. The first one we're going to talk about is what? ARV Pro, right?
Correct. The ARV Pro, it's mainly for your fix and flip or even, rehab and hold on to. Because if normally you can't get the acquisition money for, rehabbing and things of that nature, but you can get bankable loans after the fact, then just refinance out of that. But if you can't, we also offer a long-term option for you as well to keep it on our own 30-year fixed product as far as from a non-QM standpoint.
Awesome. Well, let's just
Yeah.
talk about what it is, right? Give them the base kind of outline of ARV Pro, and then I'll kind
Sure.
of riff on where I think it kind of fits in place.
Okay. Well, easily to understand. You have a loan range from a minimum of 75,000 up to 5 million, and we'll touch upon that later as far as all the way up to that jumbo size.
Mhm.
But we cover 75% of acquisition or purchase price, but we finance 100% of the rehab up to a maximum of 75% of ARV, or not to exceed that.
Mhm.
But it's definitely an option for people nowadays with low inventory. You got to find these little fixer uppers where
Yeah.
less competition and you're going to get a better deal.
So I'm going to walk through an example that I just did on my channel, right? I did a fix and flip. People can go look at the walkthrough.
Right.
I document stuff I do in my business all the time. So there's a video I
Mhm.
put out last week. I think it was last week, about a flip
Yes.
I bought. So we'll do rough numbers. I have my calculator ready so we can figure out
Mhm.
where it would play.
Yep.
And in fairness, I did this with cash. I'm in a very enviable position. I can do that, but let's just see where the ARV Pro would have played. So I bought it for 140. I put
Right.
60 in, and
Right.
I listed it for 280. So I felt 280 was the ARV. It ended up selling for 304. But so let's go through this. So if I understand you right, my
Mhm.
acquisition cost is 140. You would have financed 75% of that, right?
Correct.
All right. So hold on.
Yep.
I'm just doing the
It's gonna
math.
get it's gonna get good. Trust me, it's
All
gonna
right.
get
So
good.
I would have brought 35K to the table.
Correct.
Right. So you would have financed 105. All right. I got to get some paper here because this I need to figure out what I'm doing wrong. So 35.
Sure, no, that's okay.
No, it's all right.
Uh-huh.
I like this. People need to get your pen and paper out, folks. Do this with me. So I bring 35K to the table. You finance 105. So what am I in? So 105 grand, rough and tough
Right.
rate. What are we talking here?
What? Okay, so then now the way that the math would work is again, we finance 105. You come in with the 35, and then we throw on top of that whatever the rehab funds that you're looking, to acquire based upon your schedule of improvements. So that would just go on top. So if you're looking for 60 or up to a 60,000, then it would just be 165,000 loan amount.
Oh, wow. Okay. So
Yeah.
and
Not to exceed 75% of ARV.
All right, so let's figure out what the ARV. So 280 times 0.75. Let's just make sure what the cap would have been. So the cap.
We're well below that.
Well, I got to do the math, man. I'm
Oh,
not as fast as you.
I'm sorry. I'm a walking calculator. Sorry.
All right. So, okay. 280, which would have meant 210 was the maximum loan amount.
right?
Right. So
Not
again,
to
okay.
exceed that.
Yeah,
But there's
not,
other restrictions. I mean,
yeah.
based upon, your initial acquisition price, normally your rehab funds cannot exceed a certain,
Yeah.
overall percentage of the loan. But there's obviously exceptions to that rule again,
Again,
of course.
call or email Steve to work it out. We're
Yes.
just trying to give you a high level. So again,
Sure.
in theory,
Yes.
this one would have made perfect sense for the ARV.
Oh my goodness. You could pull out your down payment as well as some additional rehab funds to apply to the next project. If you got a good crew, because again,
Yeah.
if you can flip and fix these things under 5 or 4 months, you're churning and burning every 4 or 5 months versus 6 to 12 months where, you got to hang on to for conventional financing. So as far as seasoning, yeah.
Yeah. So let's just play this out a little bit.
Yes.
I may do this in the future. So tell me all upfront costs, right? Let's assume credit's fine.
Sure.
All that other nonsense is fine.
Sure.
So I have access to 165 grand, 105 right away, probably
Right.
60K over, every other week or whatever they are.
Well, it's dispersed based upon the completion of each phase. So the work's broken
Totally
up into 3 phases. Right.
Totally get it.
Okay.
So what am I paying you, right? So I got to pay some points, probably,
Yes.
rough and tough.
Yes.
What else is out of pocket?
Well, again, I also have to preface the fact that we don't normally go direct to consumer.
Mhm.
We're business to business, so you'd normally have to go through a licensed loan professional. When you do call me, I do have some referrals if you're not working with one, as far as competitive pricing and such. So, but other than that, as far as a lender, the normal cost on that product is actually 2 points plus $9.99 underwriting.
All right, so 165 times 2, we're going to just do rough math. So 35
Sure.
plus a grand. So I'd come out with about $4,500 on
Correct.
top of my 35K down, roughly.
Correct.
So let's call it 40 grand.
Sure.
All right, so I'm out of pocket 40 grand. No, go ahead.
Right, but here it gets better. Those 2 points can actually either be paid in several ways. You can either pay a point now with this particular, initial acquisition of the property, and then pay one later when you refinance out of it, or pay the other, pay those 2 later on when you refinance out of it. So essentially, you're paying $9.99 to me, and you pay those 2 points later, which is now not out of pocket, out of the equity after you rehab it. So it's a win-win where less costs initially to acquire, and then if you know what you're doing and the numbers make sense, then you're just paying off whatever the cost is, and you're rolling it to the next project. So it really works out with your target audience with this product.
All right, so let's just round it out. So the other thing is, I'm guessing I'm still paying you monthly, or is that all put at the end of the loan?
Well, yeah, as soon as the loan is funded, you're starting. Well, obviously 30 days from there typically is for your first payment. But yes, you would start to pay in the next 4 months, basically. And
rates are 6, 7, 8%. What are we talking?
Oh no, yes, roughly around anywhere between 6.99 all the way up to say 7.49.
All right, so let's call it between 7 and 8%. You're being so precise.
Yeah.
Okay, so I just want to play this out. So again, wow. So instead of paying cash,
right,
I could have come out of pocket. Let's just call it 40 grand. I'll pay the fees up front.
Right.
A couple of grand doesn't mean anything.
Right.
I'm going to send you a couple of checks. Let's just call it 8%. What is the check? What are my payments? Hold on. And I'm guessing I'm only paying, do I pay on the full 165 or only as used?
No, you pay on the full 165 at that time. We'll disperse those funds. Yeah. But again, it's only for like 4 months.
Yeah.
And
that's
and
that's $1,100 roughly.
Right.
So, okay. So I pay 40 grand out of pocket. Let's say it's 6 months, just again, easy math. So 6,600. So
right.
46.
So 4660. Right.
Okay. All right. And then, because again, what this is all about is how hard is my money working, right?
Right.
So let's say I made 46 grand on this deal, just for easy math. So I double my money inside of 6 months. So that's really like 200%. Where instead I used all cash. Let's see how stupid I was.
Right.
So let's say 165. Sorry.
No, that's okay. No, the math explains itself. And this is where I usually just bring up the numbers, because numbers don't lie. Once you start crunching the numbers, I can say anything I want, but if you see the numbers, you know what I mean?
Yeah. So here's the deal, right? So I could do it. I could borrow the funds. And my return is going to be roughly, again, do your own math, email Steven, work it out. But my math on my deal is 200% compounded yearly return. If I do it all
Right.
cash, like I did it, it's
Mhm.
about a 30% return. So there's a little bit of a difference there.
A little bit, like I said, leverage our funds, because usually the rehab is usually most of the cost of these
Yeah.
projects, because you're picking these properties up at such a discount. And if you only have to put down 25% and maybe even 20%, if the seller can carry a 5% second, because we allow up to a 80% CLTV. So now you can come out of pocket less.
Yeah.
Because
All
again,
right.
incorporate the wholesaler cares. I know I'm a student of your course, so this is how I know how to interject my products to to really benefit your students.
Yeah, the ARV Pro is something I need to look at personally. It's something, folks, you need to do the math on. Again, I'll be honest. Sometimes I get lazy, right? I got cash sitting in a bank account. I can't use
Right.
it. Well, I
Right.
can use it, but it's not earning any interest. Yeah, ARV Pro. That's what it's called, right?
Yes, sir.
All right. So if you're in the fix and flipping or BRRRRing or whatever you want to do, you need to check out the ARV Pro. Do yourself a favor, Stephen. How do you want them to email you? What's your email?
SDAO, which is my last name, obviously SDAO at velocitymortgage spelled out.com.
Very cool, folks. And again, I will put it in the first line in the description. You guys need to be running your projects. You need to do your math on this because,
Always.
again, as I've just shown you, I could have had a 200% return yearly compounded versus 30. That's a little bit different. So, Stephen, thanks for your time, man. I appreciate it.
My pleasure. Thanks again, huh?
Mhm.